Hi, I'm Elena of Financialdemics, and we are doing an Investing 101 series, and we are going to talk about some of the mistakes investors make, especially when they are new or they don't fully understand how it works or they're investing outside of their risk tolerance. So in this series, we have already talked about why you should start, how to set your goals, and how you should invest according to your goals. And we talked about how the stock market works. Now we are talking about those common mistakes. So if this is the first time you are seeing a video from the investor series and you have missed the other videos, then after this video, I'm going to put a link here in the eye in the sky. Go check out those videos. Okay, so when it comes to investing with anything, you should do some research. It doesn't have to be a lot of research. You can do some reading of some different books, which I can link below. You can do some watching of some YouTube videos, especially ones of people who actually, like, this is what they do all the time. You can do some research yourself. Now, you may not know it all, right? Because you have to put it all together, but you can ask questions. You can also take a course to get a better understanding of what to do. So those are things that you can do to improve your knowledge of investing instead of being confused or not taking action because you're not sure where to start. There are things you can do to help you be able to progress. And truthfully, if you already have a retirement plan through your employer, you can literally call there and talk to people and ask them questions to get an understanding of what to do, because that's their job. Don't let them make you think otherwise. Since we're talking about buying and holding, one of the mistakes that people make is they don't realize that there are accounts where you're going to set that up to buy and hold. There are accounts that you're going to set up to trade. People try to time the market in the account in which they are buying and holding. And you're not going to be able to do that in that account, especially when you are new and you don't understand anything about trading yet. Typically with time in the market, you're trying to predict when's the best time to buy certain investments or sell certain investments. And in order to do that, it takes more tools and analysis. And depending on who you are as a person, you may not have time to do that. And also, when I'm talking about buying and holding, you're not supposed to be timing the market in an account in which you are buying and holding, because you would have to spend enough time with that particular investment to predict the movement. And sometimes what you predict is not exactly what happens when you do that. It's typically something that's difficult even for like people who are experts in doing it. A lot of times it's based on emotions and not a plan, and so you either buy or sell before you actually should. And I'm not gonna say that it's always bad, because there have been people who have done well with it, but I'm telling you, if your goal for your account is buy and hold, or it's like your retirement account, you shouldn't be timing the market. Okay, what you want to do is have time in the market. Okay, when you are focused on time in the market, you are focused on investing over a longer period of time, and you are looking for your account to grow over time instead of quick trades here and there. It is a long-term strategy that definitely works, okay? And I'm telling you this because I have traded and I have done long-term growth. But again, this is investing 101. Long-term growth is what we're focused on here. The goal is to continuously make contributions into that account. One of the ways to do it is always dollar cost averaging, which means that you're consistently making contributions to the account over a long period of time. Typically, the contributions are about the same amount. Think about if you do have a retirement plan and you're participating in it at work, how you are continuously contributing that percentage every paycheck. Or even think about if you have a non-retirement account and maybe you're contributing $100 every month or every couple weeks. That is dollar cost averaging. Now, I want to say it was in the first video in this series, we talked about having a diversified portfolio. And so when you are doing time in the market, you want to make sure that your portfolio is diversified so that it's able to move with the ebbs and flow of the market. I will also mention that some of the advantages of actually having time in the market is that you're building compound interest over time. If your portfolio is diversified, you're susceptible to less risk in the market. You typically will have lower costs, right? Because when you're buying and selling, there are transaction fees involved. And so you have less fees. Historically, the stock market has a return of 10%. So if you buy and hold, over time, your account should increase in value. Now, what I'll also say about buying and holding, it doesn't mean that you have to stay in a particular investment forever. If the investment is not performing, then you should definitely evaluate that, and you may need to change your investment. So you may decide that, you know, maybe this stock is not performing the way I expected, it's been low for this period of time, and maybe you sell it and then get into another stock or another type of fund, just depending on what you're actually invested in. The next mistake that investors tend to make, I talked about diversification. Sometimes either an investor is over-diversified or under-diversified, and you have to find the right balance. So with over-diversification, you may have too many investments, and those investments may actually cross over each other. You have a mutual fund over here with Alphabet in it. You have another mutual fund over here with Alphabet, and then you own a stock with Alphabet in it. You don't need all of those funds with Alphabet in it. If you want to put more money in one of the areas, then that's fine. Like in one fund, so that you can have more Alphabet, that's fun, or one stock. But you do not need 3 different types of investment with the same funds in it. And it makes the process more complex than it really has to be. And it makes it a little more difficult, especially if you are new to investing, or even if you've been investing for a while, but it's like exhausting to you. It may be because you are over diversified. It's harder for you to track what's going on because you have all these different funds, and truthfully the funds overlap. If you are looking for like a fund with Alphabet, right, then you just really need one fund that includes Alphabet and maybe the other funds that you're interested in. You don't need a bunch of funds that overlap each other and have the same investment. And I talked to you about this before because I'm using an example of funds. Like when you have those multiple funds, remember, fees are important. All funds have expense ratios, right? So if you think about it, if you have multiple funds with the same investments, you're paying fees on all those funds when you literally could just have one, and that one fee. Now let's talk about under diversification. So under diversification, of course, means like you're not diversified enough, right? You may just have one type of investment, or let's say stock, fund, or asset class, and that's all you have. Or you have just one type of stock, right? Because when I say class, when you look at stocks, there are different classes to the stocks as far as the goals of that stock. And we kind of talked about that in video 2 of this series. You want to make sure that your account is diversified, especially if you are a person who cannot stand the fact if your account goes up in a day by a certain amount and down in a day by a certain amount. If you cannot stand for your stock to drop by $500 in a day, and I mean $500 may still be, well, depending on how invested you are, it may still be extreme, but let's just say that if your account drops by $500 in a day and you're ready to sell everything off in the account, then you are not diversified properly, right? You are under diversified. You are probably heavily in stocks, depending on what stocks you're in. If you are heavily invested in a way that is going to make you nervous and you got to get out of it, you need to diversify your account more so that it can offset some of the movements in the market. I remember actually working with clients who, like, if their account went down by like $100, they're just ready to throw the whole fund away. And I'm like, well, wait a minute, this is not how that works. And I had to explain to them how it works. And then we had to talk about, okay, maybe you want to look into diversifying your account, adding more investments. Let's see truly what your true risk tolerance is, which is basically a quiz you can take to determine, are you able to take on risk? No, you don't want to necessarily just be in everything that's safe if you're completely risk averse. You still need a little risk so that you can have enough money when you retire, but you're going to have some investments in your account that are, I don't want to say safe because I don't want you to think everything is just safe, but they are there to help perform in a way to help offset any movement that happens in the stocks, especially if the movement is down. You want to make sure that you have your account in a way that makes you comfortable depending on how the market is moving. And basically what I'm saying is everybody shouldn't be 100% in stocks. That's not who you are as a person. You're stressing yourself out. Don't do it. There are the people who could do that, and then there are people who's ready to have a whole heart attack. So don't stress yourself out. Okay, another mistake that is made is buying high and selling low. Let me tell y'all, you're supposed to buy low and sell high, not the opposite. And a lot of times that happens because you're jumping in after you're hearing the news of how a stock or a fund is performing. Like if we go back and think a couple years back, like with AMC, a lot of people who jumped into AMC was able to make some money, but a lot of them jumped in when it became a thing on the news. You bought high. And then after that, because after it hit the news, it started coming down. So now you're selling low. So now you're losing. And a lot of times what people don't realize, and I'm going to give you this tidbit here, you don't officially lose until you sell. There's a thing called unrealized loss and unrealized gains, and realized loss and realized gains. You do not realize a loss until you actually sell it. So I could be in a fund right now. Let's just talk about, I'll just use the AMC. I don't even know how AMC is doing right now. These are fake numbers. These are not real numbers. Okay. Let's say that AMC is $20 a share and I own a share of AMC. If AMC drops down to $15 a share and I bought it at $20, then I have an unrealized loss of $5. Now, if I hold on to AMC and it goes back up, then guess what? I can actually recover my money. Some of the mistakes that people make is once it drops to $15, and again, please don't take this as investment advice. This is not investment advice because I don't even know what AMC is doing. Some people, once they see that drop to $15, they actually sell. So you sell, if I sold the stock, then I'm realizing the loss. I'm not giving the stock room to go back up. So this is what normally happens when people are chasing numbers. They end up buying high because they hear about a stock and then they buy in, and then now everybody's in the stock, and the people who have been in know it's a good time for them to sell off, and so the stock price starts coming down. But you have bought high, and now that everybody's selling off, you jump to sell off and you're selling low. So now you have a loss. That's what happens when you don't really research the stock fully and you just jump into it. It's also a part of fear. You're scared that you're going to lose more money, so you jump out. Also, when you do that and you sell off quickly and you sell off low, you're actually missing out on the market actually recovering, and it can do that. I will say, I know for a fact that when I invested during the downturn of the 2008 market, the market I remember one point I looked at my account, I had lost $30,000, y'all. And I would say all of that was earnings. I wasn't even trying to log into my investment account, but I was trying to log into another bank account that was attached to my investment account. And so it pulled through and I saw it and I just was crushed, right? But guess what? I evaluated what I was investing in. I didn't sell off on anything because the whole market was down at the time. And I recovered and then some. My account has, I think my account has almost tripled at this point, the last time I looked at it, because I'm also not studying the account every single day, because that is just going to drive you insane. So sometimes you have to stay and see if that fund is going to, that stock fund, whatever you're invested in, is going to recover. A lot of that is based off of research. You can see customer sentiment. Now, I had used AMC as my example, right? We know for a fact AMC was struggling, and y'all got me tempted. I'll probably stick it somewhere when I'm editing, like what what the stock price is of AMC right now, because I have no idea. But I do know at the time AMC was going completely down, and basically the investors raised the price. Well, I don't want to say the investors, but people were buying into the stock, and it was a whole nother story behind it, but this is investing 101, and I think that's too deep. So moving on to the next mistake. Since I talked about letting go of an investment too early, there's also a mistake when you hold on to a losing investment too long. If you have been in an investment and that investment has been losing over a long period of time and you still have not sold off that investment because you have some type of emotional attachment or you're hoping they will come back, then you're also making a mistake, because that investment, especially if it's been, like I said, a long period of time, is showing you that it's not recovering and it's time to let go. Because think about it, while you're in that investment, especially let's say the investment has been losing over a year at this point, and I know somebody's gonna be like, oh, somebody wouldn't say an investment that's losing over a year. You'll be surprised. I'm telling you, because I've seen it happen. Somebody has attachment, like this the first stock I had, or this the first mutual fund I've had, and this mutual fund is not performing well, and they have stayed in it for a long time and they're just losing. You are missing out on the opportunity of being investing in something else that is performing well. And I'm not saying that you should always jump, because I already talked about that, but after a certain period of time, you should be evaluating your portfolio to see how your investments are doing, and then you should be moving out of any investments that are not benefiting your account. I will also say a mistake is ignoring your long-term plan. When you're investing, you should have a plan, whether or not like you're trading or if you are buying and holding, right? When you ignore your plan, a lot of times you end up losing in the long run. For example, if you have a fund that is doing well and is performing well, but you see this fund over here, like your fund has maybe a 8% return, and this fund over here, all of a sudden has a 12%. So you completely hop into this particular fund over here. It may turn out that that fund is more volatile, right? So maybe this year is 12 and next year is 5. Right? So don't just ignore your long-term plan. You really have to evaluate like what's in the investments, whether or not that particular fund has the goals that you want for your investment account, so that you can get to where you plan on being later on in life. You really have to stick to your long-term plan and your goals. Now, when I say stick to your long-term plan and your goals, your long-term plan is not necessarily the individual like stocks, ETF, mutual funds, bonds, whatever you have in your account. It is the goal of those particular stocks, mutual funds, bonds, ETFs in your account. So if you're in a mutual fund that is not performing, maybe it's at like a -10, who knows, and it's been losing, and there's another fund with the same goals as that particular mutual fund, but it's performing better, it's positive, that's a switch you should make. It's still on the plan for the goal. It's just that it is performing better, either due to how it's being managed or the investments in that particular fund. Another mistake is excessive trading. So I remember when I worked for this certain company that they had to actually send out a letter to a client because the client was consistently trading in their account, and it was not an account that you should be consistently trading in. So that can be a mistake. First of all, just based off of transaction fees alone, but then also like certain accounts should not be traded in. When you are excessively trading, you're basically eliminating the returns that you have gotten, and truthfully, buy and hold typically will outperform excessive trading in the long run, especially in an account in which you're not supposed to be trading in. Another mistake that investors make is the actual fear of investing at all. I literally just had a conversation with someone who has a retirement account sitting in money market. That is not how that's supposed to be. And the conversation that we had was, well, you want to be in this certain position and you are looking to build wealth, but you are scared to actually invest. As an investor, by doing that, you are missing out on the gains in the stock market, a true opportunity to grow wealth, because even though a money market has a decent yield, even though we know it's going down at this time, it is still not going to perform at the same level of how the stock market has historically performed. And so now you're not going to have as much compounding interest, which can interfere in the goals that you have for yourself. And granted, investing in the stock market is not the only way to build wealth, but it's definitely a way that you should participate in building wealth. It's a low barrier to entry, and you have so many resources out there that can help you when it comes to understanding the market and being able to increase your knowledge. If you're a person who are emotional about your investments, just create a plan and stick to it. Only monitor your account every now and then. I typically look at my investment accounts on a quarterly basis, but if it makes you that nervous, then maybe you should look yearly. Because if you feel like you're going to jump every time you see something, then you might need to push it out to a yearly process. I think you should participate in dollar cost averaging. So that's just putting in the same amount of money on a regular basis, because that helps minimize like any emotional timing. And that's something you can automatically set up. If it's not your retirement account which you're doing that in, then you can do that in other investment accounts also, where it's just automatically investing on a certain time schedule that you set yourself, so that you can make sure you're dollar cost averaging into your investment account. The next mistake investors make is not paying attention to the fees that they are being charged on their account. When it comes to fees, you don't necessarily see it when you're investing, because you're not charged a separate fee. It actually comes out of the performance of the fund. So you don't see it. When you think about it, any fees that are coming out, those fees are not participating. They're not compounding in interest. So you are losing out. Now, there are going to be some fees. It's just not going to be free. But you want to make sure you're not paying a high percentage of fees. That is the goal. You need your funds to be participating in the market. Just to give you an example, a 1% fee on $100,000 can cost you thousands over a 10-year period in the market, right? So you don't want to lose out on thousands. When investing, you're going to receive a prospectus for the funds or stocks, bonds, ETFs that you are invested in. Before you invest, every brokerage house has an actual kind of like a quick sheet that shows you like, what are the top 10 investments? What are the fees that come with this investment? You need to pay attention to that to see what fees are associated with that particular investment. So here are the different type of fees that you may find. You have expense ratios, which is the annual management fee for mutual funds or ETFs. You have transaction costs, which are the brokerage commissions and the bid-ask spread on trades. You have advisory fees, which are the fees for financial advisors, or even if you have a robo-advisor. And then you have taxes. And so taxes are either like the capital gains that you pay on any investments. If that investment does well and you sell it off, then you may have capital gains taxes. Now, what I would tell you about that is short-term capital gains rates are higher than long-term capital gains rates. And an investment becomes long-term once you have held it for longer than 1 year. Okay, so keep that in mind. So while we're talking about fees, I talked about this, I want to say it was in the first video in this series. You can have lower fees if you choose like low cost index funds or ETFs. They typically carry lower fees. Also, now there's some brokerage houses that offer commission-free trading, so that's something you want to look for when you're looking at different companies. And typically your retirement accounts have some tax advantages that help lower costs. So like your 401ks, 403bs, 457s, and 457bs, or even your traditional IRA, your Roth IRA. Now, what I will say is, anything Roth, even a Roth 401k, that is after tax. So with those, taxes are already handled. There will not be taxes on your contributions. If you have held the account for 5 years or more, there won't be any taxes on your earnings also. I don't know if you've realized if you're making some of these mistakes or not, but hopefully this was helpful to give you a little bit of information to help you change your habits. Or if you know someone who can use this video, definitely share this with them. If you have not seen the series already, I want you to go ahead and start here with the first video so that you can start investing and start building wealth.